Welcome to this explainer. Today, we're completely peeling back the layers on the most anticipated stock market debut in history to reveal the hidden mechanics actually driving the price. We're talking, of course, about SpaceX. The headlines have literally been everywhere, but what you're seeing on the surface, that is just the tip of the iceberg. $2.1 trillion. I mean, let that sink in. That's the staggering valuation SpaceX reached on its very first day of public trading. It was a massive leap, right? One that briefly made founder Elon Musk the world's first trillionaire. But you gotta ask yourself, how exactly does a company just jump to a $2 trillion valuation overnight? Is it really all just excitement about rockets, or is there something else at play here? To figure that out, here's what we're looking at today. 1. The historic debut. 2. The hidden buyers. 3. The float bottleneck. 4. The Tesla prediction. 5. The post-IPO hangover. And finally, number 6, the real lesson. Let's get right into it. Section 1. The historic debut. So let's start with the surface-level hype that absolutely dominated the news cycle. The media coverage was pretty much entirely focused on the sheer scale of the event. It was framed all around the unprecedented wealth generated, the massive $75 billion raised, and, the overarching mission to make humanity multiplanetary. The whole thing was treated as this massive cultural and technological victory lap. But when you look at the actual mechanics of the debut itself, they were highly unusual. SpaceX offered this take-it-or-leave-it price of $135 before trading even began, totally skipping the customary range. And it popped immediately, opening at $150 and hitting an intraday high of $176. What's also absolutely crucial to note here is the unusually high 20% allocation given to retail investors. That meant everyday people were out there scrambling for a piece of this aerospace giant right alongside the big institutional players. Moving on to part 2, the hidden buyers. Okay, now we're going to dive underwater and look at the hidden mechanics driving all this massive institutional demand. Because, spoiler alert, it wasn't all just excitement about colonizing Mars. The secret engine behind the initial SpaceX IPO surge is a wild market phenomenon known as forced buying. Think about it. About a quarter of the U.S. stock market sits in passive index funds. Their only job? Mirror list like the NASDAQ 100. So when a new stock joins that list, these funds don't care if the company is profitable or if the stock is actually cheap. They literally must own it at whatever price the market sets. And this brings us to some truly brilliant research by Puya Bemaram. SpaceX is set to enter major index families on a fast track across 3 distinct waves. By calculating the assets pegged to these indexes, Bemaram shows that passive funds are mathematically required to buy about $9.2 billion of the stock globally. There is absolutely no way around it for them. So the crucial point here is understanding the behavior of the 2 main players. Like we just said, passive funds, they are buying blindly. But what about the active fund managers, the actual stock pickers? Well, according to historical data from hundreds of previous index editions, active managers mostly just avoid the frenzy. Actually, they act as net sellers, happily handing their existing shares right over to the passive funds who are forced to buy them. This dynamic is so fascinating to look at. Mechanically, if every single benchmarked manager bought the stock, demand would total over $17.5 billion. But behaviorally, once you account for those active managers who just refuse to participate in the madness, the real inevitable demand drops down to that $9.2 billion mark. Which brings us to number 3, the float bottleneck. Now, let's be totally clear here. $9.2 billion is still an astronomical amount of forced capital flowing into a stock, especially when you consider this next major factor. Remember that wild $2 trillion valuation we talked about? Well, out of that massive number, only about $75 billion of the stock will actually freely trade on the market right now. The rest of it, locked up for as long as a year. So that means the freely trading shares, what we call the float, represents barely 4% of the entire company. This creates a severe float bottleneck. Just think about the physics of this for a second. You are squeezing over $9 billion of massive, mandatory, blind demand into a tiny $75 billion pool of available shares. When buyers who literally cannot say no are forced to buy from a tiny pool of available stock, it artificially drives the price skyward. It is basically simple supply and demand on absolute steroids. Part 4. The Tesla prediction. To really understand what happens to a stock after a bottleneck squeeze like this, we don't even have to guess. We just have to look at history. Back in 2020, Elon Musk's other massive company, Tesla, experienced this exact same forced buying phenomenon. When it was announced that Tesla would enter the S&P 500, index funds suddenly had to buy a tenth of the entire company. The stock soared 40% right up until inclusion day, all because speculators bought in early, knowing those index funds were coming. But on the actual day the index funds finally bought in, the stock slipped. Using that exact Tesla data, Bahamaram created a forecast for SpaceX, and he predicted a sharp double-digit inclusion premium, heavily front-loaded into the IPO itself. Why? Because Wall Street is smart. They knew the rules, they knew the dates, and the extremely thin float was all public knowledge. They priced in the forced buying before it even happened, meaning the real money is made by investors who get in early and sell into that forced bid, not by the guys arriving late to the party. Section 5, the post-IPO hangover. And man, that incredibly accurate prediction leads us right into the harsh reality hitting the market in the days following the IPO. The hangover has definitely arrived. The post-IPO frenzy is rapidly losing steam. Right after the debut, the stock dropped over 8%, wiping out roughly $150 billion in market value in a single day. What we're seeing is early investors and hedge funds simply taking their profits. And who's left holding the bag? Usually, it's the everyday retail buyers. If you scroll through social media platforms like Reddit, market sentiment shifted incredibly fast, with a lot of users characterizing the whole event as a pump and dump, designed just to provide an off-ramp for early startup investors. Taking a closer look provides a pretty sobering reality check. As Analysts from Wex points out, the fundamentals are finally catching up to the stock. The valuation is honestly extreme. The company is trading at roughly 112 times its revenue. Plus, despite its massive size, SpaceX isn't even profitable right now, posting a near $5 billion net loss last year. Add in the fact that early resale rules are going to allow insiders to flood the market with more supply, plus the risk of a looming $20 billion bond sale, and yeah, you can totally see why the market is aggressively repricing the stock. This all brings us to an incredibly sharp observation from a market watcher. They pointed out that the entire structure of the offering, the tiny float, the fast-track index inclusion, it all seemed totally designed to pump the value just long enough for the forced institutional buyers, like pension funds, to show up and buy the shares at a premium. Finally, part 6, the real lesson. So, having looked beneath the surface of the hype, the numbers, and the sudden drop, what should you actually take away from this entire financial saga? Well, the ultimate lesson of the SpaceX IPO isn't really about rockets, artificial intelligence, or building multiplanetary species. It's actually a live experiment revealing the profound, hidden power of index providers. These list makers, they used to just be referees. But now, with a single rule change, they can mandate billions of dollars in stock purchases and completely dictate how hard that demand presses on a dangerously thin slice of shares. Which leaves us with a critical question to consider. The next time we see a headline-making stock surge, are we really seeing the true, fundamental value of a company reflecting its actual business success? Or are we just watching the mechanical forces of the list makers at work? Thanks for joining me on this explainer, and I'll catch you next time.